According to Mark Cuban, if you use credit cards, you don't want to be rich.
Brian, I am excited to talk about this because Mark Cuban is a guy that I generally like. You know, he's been wildly successful as a business owner, as an entrepreneur. He's on Shark Tank. So generally, when someone who's had that kind of success says something, I want to listen. I want to learn from them. I want to glean some of their insight. But on this particular topic, I don't know that we are going to agree 100%.
Well, let's give our audience some context here. There's actually a clip out there. Let's let everybody see, and then we'll kind of go through the ins and outs of this.
All right, check this out.
If you use your credit cards, you do not want to be rich.
Well, anytime you say something about debt, people send it to me. Look
Right,
what Cuban,
I
look what Cuban said.
Tweets, yeah.
Look at what Cuban
and
said.
vice versa.
Yeah, so cut up your credit cards. If you use a credit card, you don't want to be rich.
Yep,
I like that line. That's a good line.
That's my favorite line. I tell it
I
people
don't
all
think
the
that's a
time.
great line.
People then they ask me, well, where's the best place to invest? I said, your best place to invest is to pay off all your credit cards and burn them, because your credit card, you know what your return is, right? If you get off, you're paying 15, 20% interest. If you pay that down, you just earn 15 or 20%.
I agree
Folks,
with that.
I told you 100 times, and Forbes 400 wealthiest people in North America, when surveyed, asked what's the way to build wealth, what's the number one way to build wealth. 75% of wealthy people, not your broke brother-in-law with an opinion, but wealthy people say, get out of debt and stay out of debt.
Yep.
Because it gives you power over your largest wealth-building tool, which is your income.
All right, Brian. So I don't disagree with all of that, right? Like there were some glimmers in there that I'm like, oh yeah, I like that. Oh yeah, that's good. I agree. However, there were some parts on there that I just don't know that I'm willing to like dive headfirst into and say, oh yeah, that is 100% something that I subscribe to in the way that I behave in my personal financial life.
This is one that's kind of, it's touchy in the way that I know all of my financial mutants. I'm not worried about you because I've shared nobody shows up here to become a prospect with credit card debt. However, to say credit card use in general is going to make you not want to be rich
It's just
seems
not
like a
right.
bridge too far. But here's where I'm in conflict. I know that the majority of people who use credit cards are not paying it off monthly. And that breaks my heart. I mean, it's just horrible.
And we know that if we're going to think about, okay, what do we agree on? If you are someone who falls into that camp, if you're one of the people who is carrying credit card debt and who's paying those punitive high interest rates, then I would agree with Mark Cuban that one of the best places you can quote unquote invest is to pay off all of your credit cards and not do that and not utilize that. On that, I would agree with him. And it seems like a vast majority of Americans fall into that camp.
Yeah, let's actually get into the numbers. We actually like to show you the numbers, and you can see the current number is 55% of Americans carry a credit card balance from month to month. I mean, that's what, because I want to go ahead and put it out there. We don't love that. And then the average balance, unpaid balance, is around $6,500. But it goes worse. 45%. Now, here's the good news. This is of the people who are using the credit card debt. 45% of Americans have over $1,000 in credit card debt. 15% have over $5,000. 6% have over $10,000. So you can see that $6,500, fortunately or unfortunately, if you're one of the people, is skewed by the people carrying very large balances.
But why do we hate this? Because we know that right now the average interest rate on credit cards is a little over 19%. It's 19.28%. Well, we talk about all the time how compounding interest can be the eighth wonder of the world. It can be the thing that is your fiercest ally when it comes to building wealth. But if you do it the wrong way, if you let it start working against you, boy, is it a difficult adversary to overcome. That's why we don't like credit cards. That's why we don't like carrying credit card debt, which is different than utilizing credit cards.
Yeah, I mean, because if I could make 19% on my money, that would be awesome. And you heard Dave gave the stat that 75% of wealthy people say getting and staying out of debt is the best way to build wealth. Well, it's hard to go against that. But there is something I do want to make a point of clarification, because I think this is something that makes the financial order of operations so unique, is that we will have, like, step one is I want you to have your insurance deductibles because that keeps your life out of the ditch. But everybody's always kind of perplexed by step two, employer match. That's coming up before high interest debt, which credit cards clearly are sitting square in the middle of high interest debt. Why in the world would we have that be the case? Well, remember, a lot of your employers are offering you 50 cents on the dollar match, dollar for dollar match. That is a 50% for 50 cents on the dollar, 100% for dollar matches, rate of return guaranteed. It's hard to overlook that. Now, look, don't mishear me. If your employer is only saying, I'm going to give you that dollar for dollar on the first 3% of your compensation, I want anything above that 3% to be tackling that high interest debt.
You got to knock it out.
100%. You got to get rid of that, because if you're not making 19% on your money, you are digging a huge hole for yourself, and you're letting compounding interest actually work against you.
You mentioned that Dave used that stat. He said 75% of wealthy people say that getting out of debt and staying out of debt is the best way to build wealth. He's right, but I think we would put a caveat on that. We would say that for the majority of wealthy people, getting out of high interest debt and staying away from high interest debt is the key to building wealth, because we're going to talk in a moment about how we disagree a touch on is truthfully getting out of all debt in all circumstances for every person the absolute best strategy forward.
Yeah, I mean, the quote, because let's kind of jump into this, what we disagree on a little bit. The quote was, if you use credit cards, you do not want to be rich.
Well, so quick question, Brian. Do you use credit cards?
Yeah, that's why I want to make sure we eat our own cooking. I mean, we'd be hypocrites if we didn't actually share. And I want to go a little deeper, because I know it's very easy for somebody who struggled with debt in the past and got themselves in a pickle, which we know, unfortunately, Dave has gotten that. So he goes a teetotal route on all debt. But here's what we found from our own research. 97% of the millionaires we survey, our client base, they use credit cards. Now, there's a big difference between using credit cards and then having credit card debt. Because I've told you, no prospect shows up here with credit card debt. That's considered basic. That's basic discipline. That's common sense. You don't run credit card balance, because you'll never get wealthy. And that's how I'd modify this. Mark said, if you use your credit cards, you do not want to be rich. I would challenge, Mark Cuban is using credit cards.
I would think so, but maybe he is a teetotaler, because Dave is a teetotaler. He doesn't do
Mark
credit
Cuban
cards.
is using credit. You cannot tell me he didn't buy the Mavericks with some form of debt.
You would think so, right? Like, you would think that he would have been using debt instruments to his advantage, not a complete teetotaler. But it's interesting how those two things, when you take such a hard line that if you use credit cards, you don't want to be rich, that just can't be true, because we know a lot of wealthy people that use credit cards as a tool in their financial tool
Well, we
belt.
went around and asked every one of our financial advisors, are you a debit card user or are you a credit card user? And I thought we'd have a few debit card users. We did in our support staff. We had no financial advisors that were using debit cards over credit cards. Now, and I'm not against debit cards, but I just want you to know that, once again, we eat our own cooking. I think that we need to clarify. Credit card use, okay. Credit card debt, that's no-go territory. So you no way you want to have that. So credit card use, okay. Credit card debt, no way. And that's how I'd modify Mark's statement. If you use your credit cards for debt, you're working against ever becoming rich.
And so, Brian, being that we are advocates, we both use credit cards personally. Let's talk about some of the reasons why we do, some of the reasons why we think that it can be a valuable tool inside of your financial tool belt. And one of the things that a lot of people don't realize is when you use credit cards, oftentimes you actually get better fraud protection than if you were just using a debit card. If you were to have some sort of fraudulent transaction that takes place and it happens on your debit card, but time passes and maybe you don't recognize it on the first billing cycle or second billing cycle, it can be really hard to claw back and get those dollars back, because it is money that came out of your checking account that has now disappeared that you have to prove was fraudulent. When it's with a credit card, it's much easier. It's the credit card company's money, and you're usually only liable up to $50 for any fraudulent transaction. And in most circumstances, at least most that I've seen, the credit card company won't even charge that $50. It just keeps your money completely separate from the folks that are trying to get into your back pocket.
Yeah, in this new modern world, just sometimes when you're buying deals and other things on websites, it can be kind of a scary place. It's nice to use the bank's money instead of your money and know that you're going to come out on the other side okay. I do love the rewards.
Oh, it's
I
huge.
just got back from a trip I took over Thanksgiving. And not only did I get a few $100s of resort credits while I was at this hotel over the holiday, but I also got free breakfast. I mean, if you add this up for a family of 4, this is hundreds of dollars just on this one trip. And I'm sitting there going, look, I'm paying this off. I mean, matter of fact, I've already paid it off. As soon as I ran payroll for this month, I immediately paid off every one of my credit cards. I'm one of those people, just like a dollar cost average weekly into my investments, I find myself paying off my credit cards almost weekly too, because I pay attention to how much of that credit utilization and where the credit score is going. You do not have to be a slave to this debt. You can use this as a tool, but you have to know if you actually are the one that's in control of the situation. If you are, because I think that, look, Dave has shared that he is talking to the 80% that struggle with the behavioral parts. And I just shared the stat earlier, 55% of people who are using credit cards are carrying a balance. That's a disaster. So, I mean, it's hard for me to say that they're completely wrong when the majority of Americans using this type of debt are using it inappropriately. But I also think it's wrong to say that my financial mutants who never struggled with the basic common sense of, hey, I better pay off this thing that has a punitive interest rate, to tell you can never use it, that seems ridiculous.
Now, there is one thing that you have to also make sure that you're aware of. Even if you're not someone who you know that I'm not going to carry a credit card balance, I'm not going to carry it over month to month, you do have to understand your behavior. If you're someone who thinks because you are using plastic that you are more likely to spend money, that you're likely to run up higher balances, of course, be aware of that. We're not suggesting that that's not a real behavioral thing that folks fall into. But if you're someone out there who's Black Friday shopping, you're shopping on Cyber Monday, and you're going out there and you're getting deals, why not use that cashback rewards card that not only are you getting that great deal on the product or the thing that you're buying, you're also getting 2%, 3%, 5% cash back at the same time for money that you were going to spend anyways.
Yeah, I think that this is kind of one of those differences I've shared with you guys. It's probably been a while since I've reminded everyone. Part of being a financial mutant is I want my money to essentially go 5 to 15% further than my peers, because a lot of people around you, your friends, your family, and coworkers and so forth, they just kind of let life happen financially to them. I expect more out of my army of dollars. I'm kind of expecting them to go further, to do more, to work harder. And if I can get just a guaranteed 2% automatically just cash back, as well as all these rewards, protections, and other things, man, I'm already getting close to half of that 5%. Because we were talking about insurance premiums, utilities. These are all things it's not behavioral that by using a credit card that I've actually encouraged myself to spend more money.
This money you're going to spend anyways.
I'm going to pay my utilities. I'm going to pay my insurance premiums. I'm going to pay that stuff anyway. Why not maximize what these dollars can do for my wealth building journey? Then you'll probably recognize, hey, okay, so we're a little different. Dave has a very big financial influence on people who struggle with the basics. And we kind of applaud that.
Sure.
I think it's great because we've had relatives, we say, get out of debt. They don't listen to us. And then they go to financial peace. And all of a sudden, hey, I got to get out of debt. And we're like, duh, we've been telling that for years. But we know that our audience is for those financial mutants, those that don't struggle with the basics, who can go beyond common sense and actually want to maximize every dollar. So if you like hearing our differences from other systems, we actually have an upcoming show this Friday where we will be comparing the baby steps to the financial order of operations, what we agree on, what we disagree on, so you guys can kind of self-diagnose. Hey, where do I fit into this? Am I a person that needs to work on the basics of discipline, or am I somebody who needs to be a financial mutant in training where I'm actually trying to maximize every dollar that comes into my command?
All right, guys, so we love that we get to put together this content, come up with these ideas, come up with this curriculum for you, but we also love when we get to answer the things that you care about, the questions that you want us to weigh in on. So right now, we have the team out on the wings collecting questions, and we want to do everything we can to help you take your finances to the next level. So Reby, with that, I'm going to throw it over to you.
All right, we've got a question from Warren W. to kick us off. He says, what is the best credit card out there? Rewards, etc. What should he be looking for? He pays it off every month without question. So what do you think?
So this is subjective. I think this is very much experiential. In my opinion, there is not a best credit card. For most financial mutants, there is a credit card suite or a stable that might be really useful depending on the way that you consume and your behavior. I personally, Brian, I'll be curious to get your way in this. I really like cash back cards because we don't travel a ton. I don't necessarily need the travel rewards or the miles as much. So I love that whenever I get a card or select a card, I really like to either get a discount on my purchase price or physically get cash back. Do you agree, or would you do more of the travel stuff?
No, I think it is very much a personal decision. And first, I also want to give the disclaimer. A lot of influencers get some type of money for recommending credit cards. We don't do that. We don't get into that game. So I'm only speaking as Brian, the user of credit cards, Bo speaking as Bo, the user of credit cards. I do agree that I think for the lion's share of folks out there, like that Fidelity Visa credit card that doesn't have an annual fee and will pay you 2% back with no caps, is a really good foundational thing, because you don't have to worry about which quarter you know, because some of these, like Discover and some of the others, they're great until you realize that it's kind of a trap that you have to keep up with which spending categories are paying the 5%, and who wants to, you're in the messy middle of life with kids, responsibilities, work. Let's just keep it simple if we can. I will tell you though, for those financial mutants that have reached a level, and that's a good core one. But I will tell you, my mind was blown when we had Clark Howard on, who I consider just a huge inspiration in my financial life. And I know how tight Clark is. For anybody who's from the Southeast, specifically Atlanta, you know Clark can make a dollar dance. I mean, it's an amazing thing to see what he can do with his wealth building journey, and how he shared that in a very abundant cycle type of way. And when he shared his credit cards with us and I saw that Amex Platinum, I was like, what?
Clark Howard?
Clark Howard has an Amex Platinum? That card has like a $600 or $700 annual fee. My wife has been asking for that for years, but there's no way I want to pay $600 or $700. When I saw that Clark had it, and then I really went a deep dive into the rewards, for somebody who's reached a level of success that you are traveling a lot. And that's kind of, now that the world is opened back up, I will tell you, I immediately after we recorded that show went and opened an Amex Platinum, and it is incredible. Don't do this. Do not speed this decision up if you're in the beginning of your financial journey. This might even be, if we were putting a financial order of operation, maybe the Amex Platinum is step 8 of the financial order of operations, because it's not something, you should not aspire to have a $600, $700 annual fee. But I got to tell you, now that my wife and I, with our daughters, are traveling more, we are stacking the benefits up on it, and that's pretty powerful.
But I think there are, even if travel is your thing, I mean, I think there are other cards too. Even if you don't go with the Amex Platinum, like the Southwest card, I know is one that's really, really popular. That a lot of people who fly Southwest, it's a pretty decent card to use. Again, like you said, you have to be someone who travels to be able to justify those benefits. The other thing I like to think about are, what are the things that me and my family do often? We go out to eat and we put gas in the cars, because my wife is constantly having to take kids to activities and that kind of stuff. So a card that offers a special benefit for eating out type things as well as for gas type things makes a lot of sense. And we get a lot of smiling boxes that show up on our front doorstep. So if there's a card out there that makes the smiling boxes a little bit cheaper, that's not a horrible solution. So to solve those two problems, we use the city card as our like eating out and gas card. I mean, the city Costco card. And then we use the Amazon card for all of our Amazon or Whole Foods purchases, which is great. Those are places that we're going to spend money anyways. And since we're going to spend money in those places, we have a card that allows us to get a little bit of benefit from doing that. And of course, we pay all of them off every single month.
Yeah, that's the big takeaway to close out. Pay it off every month. Remember, credit card use, okay. Credit card debt, no way.
Absolutely. All right. Thanks so much for that question, Warren. Kevin has a question for you guys. He says, I'm 19 and in college, and I have enough money to either pay for my school or max out my Roth. Which should I do?
Wait a minute. I feel like we're being trapped here.
Well, here's where, Kevin, I'd like to have a dialogue back and forth with you. Because the question I want to ask is, all right, well, if you don't pay for your school, who's going to pay for the school? Like, is this something where, like...
I believe it's like taking out student loans.
Like, go get student loan debt. Should I go incur student loans, or should I max out a Roth? I've got kind of my thought on that, Brian. What's your do you want to weigh in on? You want me to tell what I think, and then you can correct me?
Go ahead and go first, because I definitely have some opinions on this.
So a lot of times when folks are in college or folks are young, and they're like, man, I've got my money in my savings account, but I really want to fund the Roth. And I tell them, hey, one of the little known things about Roth IRAs that's great is they can serve as an emergency piggy bank. A lot of people think, okay, I got to put money in there and I can't get to it till I'm 59 and a half. And that's true. That should be the goal. That should be the strategy. However, you can always get to your basis, the contributions, the money you put into your Roth pre-59 and a half without taxes and without penalties. It's a little known secret that a lot of people don't know about, but I would not encourage you to use that. For young people who are trying to decide, oh, I'm nervous. What if I need that $1,000? If I need that $2,000? I tell them, hey, well, let's think about funding the Roth, because if push came to shove, worse came to worse, you could get that money back. In this situation, though, it's a little bit different, where normally I would tell somebody, hey, do the Roth, get that money working, get it in there early. I don't know that I would tell you to do that in lieu of going out there to accumulate student loan debt. Because the wonderful thing that you have going for you, Kevin, is even at 19, or especially at 19, you have the most valuable resource in the world on your side, and that's time. You can go look at our wealth multiplier, go to moneyguide.com/resources, and look at how powerful $1 can be for a 19-year-old. Well, what I want to encourage you about is $1 is still really, really powerful for a 20-year-old or a 21-year-old. And what I don't want to see you do is I don't want to see you, if you can avoid it, go through college, continue working through your career, and building up this student loan debt that on the day that you graduate, when you come out of school, you're immediately starting with this burden behind you that you have to claw out of, that you have to get out of. If you can start with a clean slate and be dead at zero without having debt, I love the sound of that, so that when you start working, when you get that first job, absolutely start plowing money into the Roth IRA, start building through your savings. In my opinion, I would probably encourage him to not rack up student loan debt to go fund the Roth at this age.
Yeah, I mean, I'm in agreement with that. Look, this is where I love the mathematics of dealing with finances, and the fact that maximization-wise, you probably could say, hey, we're in a bear market, so valuations are compressed. Every dollar you put, especially for a 19-year-old, is going to be turned into an incredible wealth-building opportunity. But from a behavioral side, there is a risk, because I see so many people, young people, are in these traps of lots of student loan debt that I think keeps you, because debt is a constraint, and it's an encumbrance to keep you from having the flexibility to make decisions. So this is one of those things that goes beyond the mathematics, and it's more of the behavioral side of it. Is that I would, if you can come out of college debt-free, do it. Mm-hmm. I mean, because if you can come out of school at 21, 22 years old, no debt, and then you can hit the ground running. Now, yes, there is an opportunity cost, incremental decision-making. You are foregoing putting that Roth money in, but you're also building the habit of, you're going to respect the tool of debt in a way so that you don't, because I'm just worried if you start going down this path, that in the short term, it could look like, man, I'm a genius for doing it this way. But if you don't set firm boundaries, you might find a few years in the future you start justifying other exceptions to the rule, where it's being regimented, disciplined is one of the key recipe ingredients for building wealth. So I would focus on trying to be debt free. Now, look, also focus on, are you focusing on a major that will have great earning potential after you get out? Are you also making sure you're paying attention to what's going on in the world of student loan debt, because that has something to do with it? So maximize all the decision making there, but definitely, I mean, I would love at some point when you do get out of college that you can start maxing out that Roth.
And tell me if you've because when you were coming through school, were student loans like super popular? Like, did a lot of your peers, were they having to get student loans to pay for college?
They were, but the numbers were significantly lower. As we've shared, I mean, we've done education shows, and it makes me so sad because I'm a huge proponent of education. It's what we come from, humble beginnings, but the ladder of opportunity was getting a good degree and a good education, and then earning great earnings from that education. And I feel like sometimes younger people don't have that same path, because why did my University of Georgia education cost $3,000 a year when you went through, I think it was probably a little under $10,000
that,
a year.
yeah.
And then when Daniel goes through UGA, it was like 17, 18,000. Now it's over 20,000. And you're like, why did those degrees have to run up? I think institutions ought to be held a little more accountable. That how do you spend at those levels and not have some type of reckoning? Because if I went out there and went crazy with my spending, there at some point there's going to be a reckoning for me and my household. I feel like we've done everything in the world to talk about without holding the institutions that have run up these expenses. Because somebody just explained to me, how did we go from $3,000 a year for me, same institution now charging over $20,000? What happened? So, I mean, is education, was I getting only a tenth of the value? I don't think so.
Here's where I was going with the.
Yeah, I went on. I got.
Here's where I was going that line of questioning. I think one of the things I've seen a lot of my peers fall into, or folks who have come through college, is when you take out student loans, it almost feels like funny money. It feels like a blank check. Like, oh, okay, well, I can go out to eat and I can go
I
do
knew
this.
people paying for beer with
exactly,
student loan
right?
debt.
And people covering their dues for Greek life or whatever the thing is with student loans. If you can make hard financial decisions hard, I think it's going to change the way that you approach making those decisions. So I love you having some skin in the game, paying for your school instead of just relying on the student loan debt. I think it's about building that behavior early on.
For sure. And now pull me back if I'm thinking of this incorrectly, but like his question was get loans and like max out the Roth. It's like if you have a little extra,
of course,
throw some in the Roth.
Absolutely.
Like 19, your dollars are so powerful. And so listen, when you can max out your Roth, do it. It's amazing. Fantastic. It's part of our steps in the financial order of operations for a reason. But I think he maybe is thinking very polarized here. And there
it
might
doesn't have
be
to be an all or nothing.
Yes.
If there's $1,000 left after he pays for his education,
yeah. Like when you're
take advantage of what
19
Bo
and in
was sharing with
college.
the flexibility of the Roth and put that $1,000 to work.
Right. That was immediately came to mind. I was just like, yo, there's still opportunity here without going into more debt. So thank you so much for that question, though. That was some great conversation. All right. Dane has a question. He says, what advice would you give to individuals for saving and investing when their profession is in sales and where their income can fluctuate month to month? Still save 25% regardless of income?
So this one was Daniel?
Dane.
Dane. So it's not uncommon. We have a lot of clients who work in industries and maybe they're in sales, so they fluctuate, or maybe they just get paid more based on company profitability and that sort of thing. So you see these wild fluctuations in income where on a month-to-month basis, the incomes might not be all that impressive, but when you look at it on the annual, because these big bonuses or these quarterly bonuses, it can get out of whack really quickly. Well, one of the things that we do when someone becomes a brand new client is we prepare for them their personalized financial order of operations. Here's exactly how much you should be saving, and here's the order in which you should save it. We call it the foo for you that we design when someone becomes a client. Well, a lot of people, we go through that and we say, hey, last year you made, I'm going to make up a number, you made $300,000. So you need to be saving this much, and this is what that comes out to monthly. And you can literally watch their eyes get this big. I mean, they just blow up because I can't do that on a monthly basis because my income doesn't come in that way. So Brian, I know when I work with clients talking through this, what I tell them to do is, okay, let's normalize what we think your monthly income is. So if normally your monthly income is $10,000 a month, let's set up an automated savings behavior based off of that base income, right? So $10,000 a month, let's save $2,500 of that every single month. But as quarterly bonuses come in, as annual bonuses come in, we have to make sure that we're saving a big chunk of those, because if those bonuses come in and all of a sudden it goes to the new car or it goes to the swimming pool or it goes to the vacations and a chunk of it does not get chiseled off for savings, you're never going to hit that 25% savings rate. You may think in your mind, oh yeah, no, I'm saving 25% because I'm doing the base amount. But if you're not doing it from the quarterly and the annual bonuses, you're going to blow it up and you're not going to actually be able to save enough money to truly replace the income that you're actually living off of. So I like the stable and then catch up with the bonuses.
Let me give you the nuts and bolts of this. There's three components that are going to be really impacted when you have a not normalized income stream. And by the way, this is no different when I used to work with professional athletes. A lot of people didn't realize they only got paid during the season. So they'd have all this huge money come in, then during the summers or the off season, they'd be completely broke. So you'd have to normalize this. Well, salespeople are kind of the same way because it's feast or famine on how the money's coming in. So here's the 3 components, nuts and bolts wise, that you better have under control and have a plan for. Cash reserves. Your cash reserves are going to be so much more important for you because that's going to give, and that truthfully, if you have fluctuating income, that's probably going to be an indicator that you need to, when you're looking at like a 3 to 6 months cash reserves, you're definitely going to put the needle closer to the 6 months because you have so much variation in your income. You need to have something to bridge those gaps. So that's the first thing, is having a good solid cash reserves. But there's a component that's going to be, you can't know 3 to 6 months without the second component, which is budgeting. You better actually have a plan for every dollar that comes into your control, both coming in as well as going out. So you have to do the hard work of actually doing a budget to know where you are. And then the third component is what's your goals, funding of those goals, objectives for the year. Because then you can kind of, once you have those 3 components all worked out, you can then put together that timeline that all integrates nicely. Exactly what Bo was talking about. You can have a base compensation coming in, and maybe you're trying to build, you're doing 20 to 25% off of your base salary in saving and investing. But then every time you get those huge bonuses that come in or commissions that come in, then there's a purpose for every dollar, both on the spending as well as the saving and investing side, where there's a purpose. And that's the part you have to be disciplined. And this is part of having success. And I tell everybody, you can try to aspire to have the simplest financial life possible, but with success, complexity will find you. And this is one of those elements.
Can I tell you one of the places we see people blow this up? And I'm sure you would agree with this, Brian. Somebody will say, well, hey, my income fluctuates, but I get these big bonuses. So I'm not going to save out of my normal income, my monthly income, whatever. I'm not going to save out of that. And I'll just save out of the bonus. When the bonus comes, that's when I'll hit my 25%, and I'll just save a majority of that. But then there's always things that come up, always things that money ends up getting spent before it hits the account. So if you can be disciplined at all times, not just when things are flush, but also when things are lean, and you can practice for scarcity, it's going to create that behavior where every year doesn't come and go, and you think, oh, well, okay, I'll save next year's bonus. Oh, well, I'll save next year's bonus. If you can get that in place now, you'll be amazed at how well it will build over the long term.
I think it's what you're hitting on is that there's 2 mindsets. There's the poor mindset, and then there's the abundance mindset. Poor mindset bases everything off consumption. Mm-hmm. So I have this big money coming in. What am I going to go spend that money on? Is it a nicer car? Is it better furniture? That's all consumption. The abundance wealth mindset is trying to figure out what assets or wealth building things I can actually do that are going to better me for the future. So get yourself out of the poor side of just consume to build side of abundance and wealth, and actually have a plan where every dollar is very purposeful.
Mm-hmm.
Fantastic. Thanks so much for that question, Dane. Tina has a question for you guys. She says, I'm a stay-at-home mom. Should I even worry about my Roth IRA when my husband makes over $150K a year and maxes out his 401k already? We also have over $1.5 million in investments. Ooh. So she's kind of like, what should I be doing? Should I even worry about this?
So Brian, you have an interesting thought on this. There's a thing I think that you're going to talk about that I think is interesting. But one of the things that I would say to Tina is, we love, like when you talk about the financial order of operations and you get to step 5 and we're talking about tax-free saving opportunities, and you have your Roth IRA and you have your HSA, and you say, you know what? My husband's already maxing out his 401k and he's already maxing out his Roth IRA. So right there, I know that $6,000, soon to be $6,500 is going into a Roth every year for your husband. You know what's cooler than $6,000 of tax-free money going into accounts? $12,000 of tax-free money going into accounts. That's one of the beautiful things that's available for couples where one of the spouse stays at home. Even if you don't have an earned income, even if you're not out there working, generating income outside of the household, you can still do what's called a spousal IRA. So long as your spouse makes over $12,000 a year, he or she can fund an IRA, and then you can also fund an IRA, which is an amazing opportunity for you guys as a household to continue to build tax-free dollars. I don't know if her question was around that or more, hey, does it make sense for me to have assets in my name?
Yeah, I do think it's important because a lot of people probably don't realize because they know when you hear Roth money, Roth IRA money, you have to have earned income. That is very true. However, your spouse's income applies to you having earned income. So make sure you're not leaving that money on the table, because Bo's exactly right. $6,000 going into a Roth IRA is awesome. $12,000 is even better. And this gets to the second point of where Bo was going, is that, look, when you get to estate planning, and then I'm going to tell you just personally, I think this is a good objective to have. There's what's called asset splitting. It's nice if you can try to balance, because remember, we get huge federal exemptions on your estate taxes for both spouses in the marriage. And it's not uncommon that the working spouse will start stacking money up in the fact that their employer plan is going to probably be the first account to cross 7 figures. That's what all the research shows on millionaires. But the non-working spouse, you don't want to get in a situation where you have no money in your name. Because I know in my own household, we had an issue where, not all marriages work out. And I know there was some insecurity that, when we go over the annual net worth statement, my wife was like, hey, I'd love to see more assets.
Why does my column look different?
Yeah, I'd
than
like to
your
have
column?
some
Yeah.
assets in my name. And I could tell that this was something that was bothering her. So I wanted her to have more money in her name, so that there was some asset splitting there. Not because I thought anything was wrong in the marriage, but this was good from an estate planning standpoint. But it was also, I could tell it gave her peace of mind to know that we had a strategy for also building up wealth and assets in her name. So that's probably something else, Tina, that could maximize that Roth IRA, but then also maximize, because if you already have $1.5 million, I don't know, Tina didn't give her age. I don't think
so, but $1.5 million is impressive.
$1.5 million
no matter
on
what age.
150,000 is showing that there's obviously discipline, wealth building. The compounding growth is going to make this exponentially bigger, where eventually down the road we could have an estate planning issue. Why not go ahead and get ahead of the curve on that by focusing on where you have opportunities to build some assets also up in both spouses' names?
I love it.
Awesome. Thanks so much for that question, Tina. Next question is from Chase. He says, is it a problem to utilize 0% credit cards as a short-term loan? My house is paid off and 1 year left on a car loan. Thanks.
All right. Is it a problem to utilize 0% loans? But then read it again, the part about the car at the end.
He was just giving you some context. So his house is paid off, and he has 1 year left on a car loan. That's his current situation.
And he's asking, is it a problem to utilize a 0% interest credit card or 0% loan on the car?
Utilize a 0% credit card as a short-term loan.
Okay, so here's where my mind immediately goes. You're in a great situation. You got your house paid off, right? So you don't have that debt sitting out there. I'm going to operate on the assumption if you are a financial mutant and you've been doing financial mutant things, you want to have a healthy emergency reserve in place. That should be probably somewhere between 3 to 6 months of your living expenses, unless you're closer to retirement. Then it might be like 12 to 18 months of living expenses. So I come back to the why. Like, all right, if you're thinking about utilizing a 0% interest credit card for a short-term loan, why do you need a short-term loan? You don't have debt that you're servicing, so cash flow ought to be feeling okay. I'm assuming that you should have an emergency reserve in place that you could potentially tap into, because that's another way to have a interest-free loan, is to borrow from emergency reserve and then pay that back over time. I don't know why you would need to utilize the 0% credit card interest rate. It just doesn't compute in my mind.
Well,
Doesn't
I
make
get the
sense to me.
feeling that what Chase is trying to do here is he's a financial mutant, and he's trying to gamify when banks offer you free money. Why shouldn't you try to co-create your own little arbitrage situation of take the money at zero, go do something with it, and maximize? And that sounds good on paper.
Makes me nervous.
Yeah, but this is where I always think about, and we talk about caloric spending of your resources of time. I mean, do you want to waste the horsepower of wealth building time? Because time is so valuable. Am I getting more bang from the buck by trying to go do a 0% interest loan, and opening up this over and over again? Because that's what there are people. They're very successful blogs and other things, points for travel and other things where they're just going crazy, opening up credit cards and so forth to maximize. But I put this in the column. Don't be mad. This is just me saying that's getting busy doing nothing. Because yes, in the you're on paper, it looks like, hey, I found this cool opportunity where I can go exploit this 0%. But man, you have to go open that credit card, and then you have to now keep up to make sure that they don't change the rules on you down the road, where all of a sudden now it has an annual fee, or you know, or you somehow that some credit, you know, because I'll tell you, I had a credit card that I still get mad about it, because it was one of these hotel credit cards where they charged an annual fee of like $49. And I by the way, when I opened that credit card, it did not have a $49 fee on it.
Something they added
and
later
then
on.
I never used this credit card. I hadn't used this. And so like 3 months, I noticed it when it showed up, because I look at my credit report, you know, on one of the Credit Karmas or whatever. And I noticed I had a ding for an unpaid bill. And I was like, what? I pay all my bills. It was a stupid annual fee that just, I guess, for 2 months sat out there, and it dinged me. So I got it all taken care of. But I'm just telling you, all these strategies where you have 15 credit cards out there just hanging out there, they might bite you in the rear end where you thought you were taking advantage of them. Same thing with store credit cards. I mean, one of the worst things that can happen is they offer you that 10% discount on your purchases when you're doing furniture, clothing, or whatever. And then you find out that, you know, especially if you're married, that 10% is taken, you know, because if the other spouse doesn't know, the one that's paying the bills, all of a sudden that 10% is wiped out with the late fees and interest and everything else. So I don't like when you think you're maximizing when you're actually creating complexity. I wouldn't do that, because I think that falls into getting busy doing nothing. I would just pay off you're already debt free on your house, be debt free on the car, and then load up the investing, because you're not going to build. I've never had anybody show up and say, you know what got me the wealth? I carried a lot of 0% credit card balances. I mean, it just seems like a lot of time spent for not much benefit.
Yeah, you know, there's sort of the old saying is, if you got to put it on the credit card, you can't afford it. I kind of operate, in my personal life, I operate on that. If I put something on my credit card and I know I can't pay it off in the next 30 days, right? Like it's an expense that I don't put it on my credit card. And so doing this 0% short-term loan, it just feels like dangerous territory that I think it'd probably be wise to avoid.
Yeah.
All right. Hopefully that helps you out, Chase. Thanks for the question. Lee has a very interesting question. He says, I'm 27 and saving 37% of my income, with most going towards retirement. I'm unsure what I am saving for outside of that. Should I save and keep saving even if I don't know what I'm saving towards?
I've noticed this trend. I've gotten a few people approach me on Twitter and so forth that have said, hey, I'm saving 35, 40%. What am I doing? You know, and my relatives my family starting to get ticked off at me and I do think this is something I want to challenge all financial mutants, because, you know, you get kind of addicted to saving. I've shared this before, that we know the majority of Americans are actually addicted to consumption. So you're already a financial mutant when you're a builder of wealth, and once you start seeing your money stack up and reach some critical mass points, you start going, man, this is pretty fun. I'm enjoying watching this wealth building, because I know that this is money that will work hard for me. But there is a trap that I want to encourage you, and I've picked on Bo, and I'll let him give some color on this, is that us achievers, those that are just naturally good at the basics, and you start realizing you can build wealth, sometimes there can be too much of a good thing. There's a fine line between financial mutant and financial miser, especially if you look at your life and you say, am I actually enjoying the phase of life that I'm in? But what are your thoughts on that?
Yeah, I think it's so interesting. I think a lot of young people don't know what we're saving for, right? Like, we think about retirement. I remember when I first started investing, way back when, Brian, when I first opened my first investment, I wasn't necessarily thinking about retirement. I wasn't married. I didn't have kids. I didn't know where I was going to live. I didn't know what life was going to look like. But I knew that I should probably be more like, was it the ant that stores up? It's probably more like the ant than the grasshopper, right? Like, I should probably be the one that saves for the future and that puts a little bit aside so that it gives me options. So if you're at least someone that's 27 and you're saving 37%, but you don't know what you're saving for, I would argue the thing that you're saving for is you're saving to figure it out. You're saving to figure out what your future options are. You're saving to give yourself options, because while 27-year-old Lee might not know what you want to do and how you want to do it and when you want to be doing it, 35-year-old Lee might be starting to figure that out. 35-year-old, 40-year-old Lee might be saying, hey, I might want to leave the workforce early. I might want to travel the world. I might want to downgrade into a career that's not as stressful. I may want to do volunteer work. I may want to fill in the blank of the things that you want to do. Well, that future Lee, that 35, 40-year-old Lee, is going to be excited that 27-year-old Lee, even though he didn't have it all figured out, was putting that money aside, building that army of dollars, because the faster you can stack it up early on, the more time you have for it to grow. Now, I agree, Brian. I don't think that you should live like a miser and you should not sacrifice doing the things that you want to do. But I'm amazed and so encouraged when I see these folks in their 20s with these huge savings rates that say, you know what? I'm so glad that between the time I graduated at 22 to the time I got at 27, I saved up $100,000 in my investment accounts. And yeah, then I got married and I had kids and I bought the house and we got the dog and my savings rate wasn't the same. But you know what? Because I built up that pot of money over here early that could build for me through time, it's going to do the snowball, you know, it's going to roll down the hill like a snowball, getting bigger and bigger and bigger because I did that early on. So I don't think there's anything wrong with saving for the future, not knowing exactly what you're saving for.
Well, I think, and I want to make sure that I clarify, what I really wanted was just a spot check on the happiness factor and fulfillment factor, because I think back to myself in my 20s is that as long as you stopped and you said, okay, am I happy? I mean, because to me, happiness back then was, of course, me and my spouse, but then also I had an annual, and I still do, you know, a golf trip with my buddies, and I could do all that for so cheap that I'd take and be like, yeah, I don't have anything else that it's not a car, a nicer car is not going to make me happy, or more, you know, a fancy watch isn't going to make me happy. I don't need a bigger house at this point. I'm happy exactly where I am. So if I don't have something that's going to, it's not consumption for the sake of it, let's keep building so that maybe there will be a purpose down the road that I need this. I'm A-okay with that. But I think that if you have other people in your life, like spouses, children, and other things, because I had a gentleman that I was trading text with where he was in his 40s, and he was like, you know, I have this, and it was a decent sum of money that, I mean, he was getting into multiple seven figures. And his wife was like, why do we always have to travel like so early in the morning? Why do we have to, why can't we do this a little different? That's different. Because if you spot check the happiness of you, you know, and take a temperature of what's going on, that's kind of miserly when you're still taking the 6 a.m. flights. Yeah. When maybe you can afford to fly at 9:45 now because you've put in the hard work, you've put the money to work, that you can have, start giving yourself a little more flexibility and latitude. I'm not telling you to go out there and buy the nicer car when you're 27 years old. I'm just saying make sure you're not missing your 20s, because you'll only be in your 20s once. You'll only be in your 30s once. I just want you to slow down, take a temperature reading of what's going on, that you know your why. And then if you don't have it complete, it's okay, because look, I was over saving on purpose, but I was very happy. There was nothing that I needed. Stuff didn't make me any happier. Didn't take my happiness scale up anymore. I guess I could have bought a Mercedes or a BMW in my 20s and looked cooler. Sure. But I already had the person in my life that I was like, you want to look, she already loves me, so it's okay. And she doesn't see any value in this either. So, but I am experiencing now in my late 40s, we go on trips that probably, I mean, it's just ridiculous. But it's because I was loading it up in my 20s that a lot of that stuff is multiplied exponentially. So I'm not telling you to go spend for the sake of spending. I'm just saying take a temperature check and make sure you have a purpose and a why for every dollar that comes into your command.
Good answer. Lots of good balance, food for thought there for you, Lee. We appreciate your question a lot. Jennifer has a question. She says, why is someone trying to sell me a TFRA? I think she means tax-free retirement account. And what is the benefit to this?
Did she call it a tax-free retirement account? Because
that is what Daniel and I think she means. I will be fully honest.
Look, I'm gonna go benefit of the doubt here, right? We love tax-free retirement accounts.
And we love Roth tax-free.
See, why are you gonna steal my thunder? Could you not? Could you not see the build-up
He
I
was
was
about
doing
to
here?
just set that
I had
up.
an entire narrative.
Keep
I was
going,
going to
keep
do a
going.
thing.
I'm sorry, preach.
You know what?
I'm sorry.
Why'd you do that? Tax-free retirement accounts. We love them. We love them so much. We make them step 5 of our financial order of operations, Roth IRAs. It is truly a tax-free retirement account. And then if you include health savings accounts, those are also tax-free and they can be used in retirement. So we love those. Now here's the great news.
There was a catch there, though.
Nobody has to sell you that. Were you about to say that?
I was about to say, she used the word somebody's
That's
trying
right.
to sell me. Most people, Vanguard's not out there going, Fidelity Investments is not out there going, hey, we have these Roth IRAs. They're going hot. You better get in here quick.
That's
No.
exactly right. So a tax-free retirement account that you can go open for yourself is a Roth IRA, or go open up a health savings account. And those are wonderful. And you don't have to have someone sell them to you. You don't have to pay a commission for that. What she's probably talking about, I'm guessing, is some sort of insurance product or some sort of tax-free annuity where you can build up assets in that and you can borrow money at some future point and it's going to be technically tax-free to do that. That is an entirely different thing, and I would not actually call that a true tax-free retirement account.
Yeah, because the only way it's tax-free is if you basically die with it.
Yep.
Because otherwise you might be getting married to this insurance product for the rest of your life. Because think about the fact to do what they always share in these tax-free insurance products is you build up, you overpay for insurance while you're young and healthy, so this cash value can build up in the background. And then where the tax-free comes in is you can take exactly what Bo said. You can take a loan from that cash value. But the problem is, now that once you take that loan from the cash value, what happens if you get to be late 70s, early 80s, you have a huge loan, and the cost of insurance is still building in
going
the
up.
background because you're older. You know, unfortunately, we're all going to die at some point, so the cost of insurance knows inevitably that this policy will pay out. Well, what if you burn too much of the cash value? Now the policy kind of implodes and you create a big tax
huge
liability.
tax
It's no
liability.
longer a tax-free thing. I don't like that. I'm trying to build financial independence, and financial independence to me means you have no encumbrances, nobody who can tell you what, when, and where you have to be at any point in time. And that's what, by the way, what do you think the insurance company, if you're overpaying for this insurance in your 20s to build cash value, what's the insurance company doing with that money? They're investing it. So why not take out all the middle people that are in the middle, you know, going out there, taking this, paying commissions, because usually those insurance commissions, there's a reason they can afford to have the sales force. Why not you do that? Just do what the insurance company's going to do. If you need insurance, go buy term life insurance, but then go and invest in these true tax-free growth opportunities like Roth IRAs, Roth 401ks, health savings accounts. You don't need an insurance agent to make that stuff happen.
Here's your litmus test to protect yourself against the insurance agent. Go download our free deliverable. Go to moneyguide.com/resources. Download the food deliverable. Brian, hold it up. You should not even be thinking about these types of products until you've worked through, until you've done your Roth, you've done your HSA, till you've maxed out your other retirement available options in your 401k and 403b. And it's only at that time, when you get to step 7 of the financial order of operations, would you even almost theoretically think about utilizing a product like this? And then you got to lay it side by side and say, does this product make sense for me, or does just a regular taxable after-tax brokerage account make sense for me? What are the costs? What are the fees? What's the incentive for the person sitting on the other side of the table for me? And what's ultimately going to be in my best interest for the goals that I want to achieve? And I find that most people, when you work through that process, at some point in there, you will disqualify this insurance or annuity product because it likely does not make sense
Well,
for
and
you.
go download also moneyguide.com/resources, the 8 questions to ask a financial
Yep,
advisor,
that's
because
great.
insurance agents fall into that category too. And if they tell you, when you say, how do you get paid? And they're like, oh, you don't pay me anything. The insurance company pays me this. And be like, wait a minute. No, I'm still paying you. Even though the check's coming from the insurance company, it's through the premiums, probably close to 100% of that first year premium is going to the insurance agent. Just ask those questions. Why not? Just be transparent, find out what's going on. I think that will help you make the better decision.
Love it.
Great. Thank you so much for that question, Jennifer. Hope that helps. All right, Taylor has a question. How do you decide it's time to get a new car? We have a paid off car right now, a 2005 Ford Taurus with about 200,000 miles on it, but a baby is on the way.
Ooh.
So when do you consider a car not safe, and when is it time to just pull that trigger and get the new car
You said it was a 2005 Ford Taurus,
with 200K miles on it.
200,000 miles. Ruby, I'm curious. When before Baby I got here, did you and John have like car conversations around like, oh, we need to think about a different car situation, different car circumstance?
We did, but it was more like the size of the vehicle, and it was more like down the road.
Got it.
So our cars are like, okay, they're a bit newer than 2005, and
Sure.
we determined that they were fine, and they are paid off. So that is my favorite thing about them. So I get this question. It is true. Like, how do you decide to do this?
When you and your wife were thinking about having babies and all that kind of stuff, did the car like was getting a new car, thinking about a car because the family dynamic was changing? Was that something like entered onto your radar, or no?
Well, I mean, my wife wanted an SUV, so I mean, we already had an SUV.
Because we were in the same boat. That was the big thing that changed for us. Is she said, "Hey, I'm gonna be driving around this baby. This baby better be safe," because she went into like full mama bear thing. And so that was one of the conversations we had. Is like
My wife never played the safe card. She thought SUVs were cool.
she just looked on.
Maybe I should play the safe card. I don't know.
But no, here's what I think is important. Just like I talk about, you have to have. We're unique in the fact that we offer 23/8, whereas a lot of people say just pay cash for all vehicles because they're depreciating. They're horrible for your personal finances. We've offered 23/8 which is 20% down. Don't finance more than 3 years, and make sure your payments don't exceed 8% of your income. We offer that because just like I share that the most important thing to building wealth is that you get to make it to your JOB to actually have the earned income. Right up there on priority scale is making sure that you, as well as your loved ones, are safe. I mean, look, Michelin Tires made an entire ad campaign off of how their tires were supposedly safer than all their competitors. Volvo, forever, made an entire reputation off of this. There's a reason. I want you to have peace of mind that if you had to go visit family and they're 3 hours away, that when you go get in that car in the morning and load up all the things that you have to do to keep your children, safe and happy while you're over the relatives, that you can actually do it. A car that's from 2005 with 200,000 miles on it. I mean, look, there are cars. I know people that drive, Toyota 4Runners that have like 300,000 miles, and that thing still purrs like a kitten. But if you're a tourist, if the air conditioner doesn't work, because look, I don't mind. I'm going to tell you my experience. I had a Ford Explorer, that first car of my life, and it I don't know if it had designed obsolescence in it or what, but when it hit 100,000 miles, I kid you not, we went over a railroad track and the right mirror just literally fell off the car. The display went out. I mean, when
Was
you
this the
locked
one
the
where
door,
the locks like went up and
yes,
down?
when you went, also when you went over any bumps, the door, you'd think that you had a 3-year-old playing with your power door locks because it would just start going up and down, over and over again. It had something wrong with it. But if that is the situation you're having, you do need to have some hard discussions, because just like your job and your income is important, the safety of your family is important. But that's why, once again, go back to 23/8, because that's at least going to keep your eyes in check with your wallet and your purse, so that you're not letting your ego or desire to buy too much car get in the way of actually getting safe, reliable transportation for your growing family.
And look, I've made this decision in the past where I had a car that was not necessarily on its last leg, because we tend to be long car drive. I tend to be a long car driver. I like to drive a car for a long time before we end up replacing it. But I have made the decision in the past because automobile safety has just changed over the years. Even stuff like when someone's anyway, this could be anybody, not my wife, but when someone's like backing out of a parking spot or something, there are beepers that go off that tell you, hey, there's something behind you, or like when you're merging lanes, you can see. I think those kind of things are valuable. So for Taylor, for you and your family, you got to figure out, okay, what do we prioritize? What are the things that matter for us and our family? And in our situation, having some of those new and improved safety features was a big benefit, and one of the reasons we decided to upgrade to a newer car, when we started upgrading to newer cars and having babies.
One closing statement. I had a friend, came to me, growing family. They're like, they're not the primary driver of the kids, by the way, but they're like, I think I ought to get rid of this Honda sedan for this big honking truck. And I was like, this is not the baby's talking.
And what'd you tell said friend? You said, hey, I bet you said to this friend, you'd look so cool in a truck. You ought to get a truck. That's what you said. Who cares about the family of five?
Don't use the kids. Shame on you for using the kids to justify getting the fancy vehicle. And I think they woke up. We'll talk about it later. But it's I shamed them for trying to use. You know what? Truck could really do it.
Could tote some family around. Love it. I don't know who he's talking about.
Well, Taylor, thank you so much for that question. We hear you. We feel you. Hopefully that gives you some food for thought and helps you make that decision. Our buddy Jake has a question.
Hey, Jake.
How do I not get frustrated when I have to go backwards in the FU? I was on step 7, but spending got a little out of control, and now I'm back at step 3. Sad face.
The answer to how do I not get frustrated, in my opinion, is that there's not an answer to that. You should get frustrated. It's okay to be frustrated whenever you have to take a step back. Like in your financial life, I was trudging along and crushing it. I had to step back. If you weren't frustrated with that, you probably wouldn't be a financial mutant. That's what makes financial mutants, is they do want to continue to achieve, want to continue to progress, want to continue to move forward. And so when we have to move backwards, it's naturally frustrating. Now, how you handle that frustration is different. Like if you go into like this negative, deep, dark spiral mental spin, that's different. But being frustrated and saying, you know what? Okay, I'm going to figure out how I batten down the hatches. We're going to relook at the budget. We're going to figure out how we tighten things up. We're going to get rid of the excess. We're going to cut the subscriptions. We're going to do whatever the thing is you have to do in order to work back through the FU. That shouldn't be frustration. That should be fire. That should get you motivated to start moving back in the direction that you do. So the answer is, how do I not be frustrated? Don't try to not be frustrated. Try to figure out, how can I let this setback, how can I let this thing that I'm going through right now be the motivation that when I look back a year from now, 2 years from now, 3 years from now, I say, great, that was a turning point that allowed me to take one step back and then 2, 3, 4, 5 steps forward.
I think it's interesting. We work with a lot of tech employees, and right now the tech sector, there's a lot of layoffs going on. Mm-hmm. I mean, we talk to you on the phone. We know what you're going through. When it was just a year ago, you're like, man, it's great. I can't wait to look at my RSUs. I can't wait to see what's coming in the future. And then you find out, man, there's a chance I might lose my job because a lot of these technology companies are just laying off droves of people. And it doesn't even mean that you're a bad person or a bad employee. Nope. It just means that there's a lot of cost-cutting measures going on. So it's not uncommon if somebody's asking, how do you go from a 7 to a 3? Well, there's lots of life things that can happen that can take you a step back. But that's what I want you to understand. The power of the financial order of operations, it is a maximization strategy on what to do with your next dollar. So if you have this mission to become a millionaire, you actually have the tools to know. And here's the thing. I think the first time I drive a place, I'm looking for landmarks. I'm getting confused. But then by the second, the third time I do it, I'm like, man, I got this figured out. And it's not just driving. It could be like the first time you do intermittent fasting. Yeah, and you realize, holy cow, maybe I don't, it gets easier the more you do stuff. So I think that, Jake, I would tell you to take a more glass half full, not glass half empty, is that if you went from 3 to 7 in the past, but now you've had to take a step back to tackle some things that have come up in your life, financial life, you can do this because you've already been there. You've already blazed the trail. You're not having to take the machete on thick underbrush. Now you're just maybe taking out some green shoots that you've crossed this path already. You can do it, and you'll come out on the other side better, and you now have at least a tool that helps you maximize every dollar that comes into your command.
Now, let me see if I can save you a little bit of a heartache here. Be careful allowing that frustration to result in relational damage. Because, I've done this in the past. We've made decisions where, earlier on we'd have to take a step back from savings or change something. Well, then I would be just, not like the best husband in the world, right? Like I would be like, oh no, don't go buy that shampoo, buy this shampoo. And don't, you know what I mean? And you do that kind of stuff. You got to be careful with that. Make sure that, especially if you're married, if you have a spouse, if there are other people who are involved in the decision-making process, you guys can be frustrated together and not one of you trying to carry the frustration for both of you and ending up in some relational strain. Because we know that one of the biggest things that happens in marriages and in relationships, one of the biggest areas that people fight over, is their finances. So again, be self-aware if you are finding yourself frustrated. Make sure you communicate that and have a process for working through and talking through that with your significant other.
Yeah. Good communication and even making an event. I mean, if you're taking a step back, you don't want to go do this in a restaurant, but maybe, my dating meal of choice was shake and bake. Do some shake and bake for your loved one, and then have a sit down and talk about it. Have good communication.
What's so funny is the majority of our audience, not majority of our audience, a lot of the folks who hang out with us, when they hear shake and bake, they're going to think of Ricky Bobby. They're not going to think about the chicken.
Oh, no.
Because I guarantee you, Katie right now is like, I don't get that Ricky Bobby reference. I don't understand that. Not recognizing that was part of the $7 date. She has no idea.
Yeah. My wife knows what shake and bake. Shrimp cocktail and the $1.50 flowers you can buy at Kroger.
Oh yeah.
Well, Jake says he loves the optimism and need to hear that today. So thanks for that answer, guys. And thanks for the question, Jake. All right. Luke has a question. This past year, I will have donated over $10,000 in charitable giving to my church.
Awesome.
When does it make sense to open up a charitable giving account?
So let me tell you how the charitable accounts are most often used, the mechanism, and Brian, you can talk about the when does it make sense to do that. So the way that charitable giving accounts are most often and most efficiently used is if instead of giving cash, you have highly appreciated assets that you can give. So most people, this is like stocks or ETFs or mutual funds. Maybe you bought it for $5,000 and now it's worth $10,000. You can make a donation of that appreciated security to the charitable gift fund. You'll get a $10,000 tax deduction in the year that you give it, and that $5,000 of capital gain is completely wiped away. You never have to pay tax on that. So it's a wonderfully efficient way to use a charitable giving account or a charitable gift fund or a donor advised fund. These are all different words for the same thing. That's how they are most often used. So with that, Brian, if someone's thinking, should I be a charitable giving account, donor advised fund, charitable gift fund user, what are some of the ways someone might know that makes sense for them in their situation?
Yeah, first I want to congratulate Luke. You've made it through the first. I have three things I quickly wrote down. The first was just having the intent. I mean, if you're giving $10,000 a year,
awesome.
You're charitably minded, you have the intent. So that leads to step two. Is that, hey, is there a better way to do this? Is always hunting for that better mousetrap, that maximization strategy. A lot of people don't realize that, even though you're very charitably minded, there's a chance. I don't know how big your mortgage is, if you even have a mortgage. You might not be able to itemize. A lot of people who are still charitably minded still can't itemize because itemized deductions have gotten so large. Now, look, you might still qualify for that front-end deduction of just a few $100s, but to truly itemize your taxes for a married couple, I mean, you're in mid-20 range.
Like $24,000, $25,000.
So I don't know, so you have to take into account what your taxes up to $10,000 plus if you have any mortgage interest plus the charity. A lot of people, even with $10,000, might not cross that threshold. So you ask yourself, well, wait a minute, maybe if I utilize the tool like a charitable giving account, I could stack my charitable giving. Now, that would require the discipline where maybe at one point you have to give $20,000 to the charitable gift fund. So then you could spread that giving out over the next year and a half to 2 years, and then keep, wash, and repeat that process over and over, because what that's going to do is allow you then to maximize itemization every other year. There's also what Bo was sharing with, we love it for people who have the charitable intent, is it's a kind of a completely financial mutant maximization strategy, is I love charitable gift funds because they let me give away appreciated securities. And we're just going through, well, you could partner this up with tax loss harvesting. If you've gone through volatility recently, you go ahead and harvest those losses, you reinvest that, and then you let that money, when we hit that rebound recovery, it's not unlikely that in a year after we hit the bottom of the market for you to have 40% capital gains in that account. That would be after you've held that account for 12 months, because remember, to give appreciated holdings, they need to be 12-month holdings or greater. You could give that money, to appreciated money. Your charity gets to use it at the full fair market value. You never paid capital gains on that 40%, and you get a tax deduction on the full fair market value. And then here's where the extra points comes in. if you were already investing into that same investment, say like an index fund, and you were putting $10,000 into it a year, a few $100s a month, dollar cost averaging that totaled up to $10,000 a year, you could actually take the cash that you would have given to the charity to replenish what you gave to the charitable gift fund, because what that is going to allow you to do is to push up your basis higher. It's also going to create a dollar cost averaging strategy into not only building wealth, but also maximizing what you can give to charities and others.
I'm just going to add one other thing on top of that. So you said, when do I know? One is if you have appreciated securities. Two is if it might make sense for you to do a grouping strategy. Here's the third thing, and people don't often talk about this. If you give to a lot of different charities, let's say that across that $10,000, you gave to 25 or 30 different organizations throughout the year. It's really hard to come tax time to go get all the receipts from all of those. You can use, even if you're not doing one of these advanced strategies, even if you're not doing appreciated securities, you're not doing a grouping strategy, you may want to use a charitable gift fund just for consolidation on your taxes, because all that matters are the dollars that you put into the giving account. So even if you make 1,000 contributions into it, all that matters is the total. That's what comes off of your tax return. And it doesn't matter how many different distributions you make. So you could give it to 100 different organizations. You only have to keep track of the one number, and that's what you put into the account. So a lot of people like that because they don't have to collect all this different documentation from all these different organizations throughout the year.
And then the last thing is a lot of like your church might have an account that you could just give appreciated holdings to, but a lot of times they just want stock or ETF. They don't have the ability to take mutual funds. This allows you, if you have appreciated mutual funds, this is another tool that allows you to give to your favorite charities that overcomes that problem of that your appreciated assets are in a different structure than what the church or the organization actually has the ability to take.
Great question, Luke. Thanks so much for joining us and for asking a question. All right, next up is Billy. He says, before I learned about the financial order of operations, my wife and I paid off our house in May 2020, and we were both 36 years old. I feel so bad missing the great bull market years when we were paying off our house. Should I feel this way?
Here's what's beautiful. There are so many paths to wealth. I know tons of folks who they found Dave and his structure and strategy, and they got out of their debt. They paid off their house in 7 years, and they had their house paid off in their early 30s because that's what they thought was the best decision. That was what they thought was best for them. And they have still been absolutely able to build wealth and be incredibly financially successful. There is no one finite 100%, this is the only way to do it, this is the only way to build wealth, strategy to building wealth. So I would say, Billy, I would actually flip that and say, you're 36 years old, you paid off your house in May of 2020, that's incredible. You're a 36-year-old who has exhibited the discipline to pay off your mortgage and to actually own your home. That's amazing. I would not start backtracking, thinking through, oh, well, did I optimize or did I not optimize or should I have done something different? I would use that to say, okay, now that I've done that and I can't go back in time and change it, how can I take that discipline and hone that discipline in to continue on my wealth building journey? I think that's one of the things that's really different about us, Brian, is that we're not so stodgy and stringent that we say it's our way or the highway. That's just not the way it is when it comes to building wealth.
Yeah, I want to do a clarification because I know that there are a lot of people who would be like, well, because this is the false straw man argument that I hear people make is like, well, should I go take a loan and put that money in the market? Absolutely not.
Nope.
Look, unfortunately, real estate has lots of friction costs. You know, if you go refinance and do other things, there are going to be costs associated with that. And two wrongs don't make a right. So if you've gotten this, and by the way, wrong might be a little heavy-handed because you should be commended for the discipline. Yes, maybe it's not a complete maximization, but you're way ahead of the curve. So let's, instead of worrying about the sunk cost fallacy of the decisions of the past, let's see how we optimize for the future. I kind of like, you kind of need to, now that you're already in the head start position, if you have no debt in your life, that's so much discipline that I bet you can save a large percentage of your income for the future. But you need to know what is actually necessary for your goals. And then this is one of the things, if you go to learn.moneyguy.com, we actually have a course called What's Your Number? Or Know Your Number is the official. What's your number? Know your number. Come on. We're all playing horseshoes here, guys. But if you will go check this out, because I think that you need to have a purpose of knowing, well, how much of my income do I need to be saving? Am I at that 25%? Am I potentially even lower than that? Or do I want to retire earlier? You need to have some purpose for what your dollars are doing for you. And I at least think if you have that, because one of the things I'm very proud of is that we actually have built into the tool the ability to kind of know what is saving an extra few $100s more, or maybe if I take a little bit off the top, what that means. So you'll actually know what you're saving for to kind of get that purpose all figured out and honed in for you. So you can maximize every dollar that comes into your control.
And I think you should feel proud. Yeah. I don't think that you should be like downtrodden on yourself for being in an amazing financial situation. He put in here, Brian, 36 years old, paid off in May, and I think they have $800,000 in their investment portfolio.
Yeah, that's a win.
You are crushing it. You're doing an awesome, awesome, awesome job. Keep doing that. You are going to be financially independent. You're going to be able to do all the things that you want to do, even if you did not optimize every step of the way. I think you should be proud, and I think that, if you were here, I'd give you a high five, because I think it's awesome.
I mean, one of the things I'll share from my own experience is that I've made a lot of financial mistakes, and I'm still successful. It sounds like the exact same thing's going on for Billy. And I already made the joke that I was playing a game of horseshoes. Really, finances are that way. You don't have to hit the bullseye on everything you do. You just need to get enough of the things, enough of the incremental decisions right, that when you stack them all up, the momentum of critical mass has been reached. And by the way, Billy, paid off house, close to 7 figures in liquid portfolio.
Not even 40 years old
man,
yet.
That's crushing it. That's definitely a financial mutant.
For sure. Virtual high five, Billy. Thank you for your question, and thanks for joining us in the live stream. Guys, we love hanging out with you every single week, 10 a.m. Central. We love answering your questions. So thank you so much for being here and for providing such fantastic conversation every day. If you haven't yet, you can head to moneyguy.com/resources to download any of the free resources we mentioned today, plus tons more, tons of topics there to just help accelerate your wealth building journey and help you clarify some of your questions.
Guys, I'm your host, Brian, Mr. Bo, Reby, and the rest of the financial content team, Money Guy team, out.